Good afternoon, everyone. My name is Jeffrey Scott, and this presentation is brought to you by the North San Diego County Board of Realtors, and it is being recorded today. We'll start here shortly. Does everybody have access to the chat box? If you would, I don't have two-way communication, so I don't know if you're there or not. Maybe you just chat your name in that you're hearing me okay, loud and clear. Hi, Therese. Lenore, hello. Welcome. Oh, yes, welcome. Great, we'll give it a minute longer and we'll jump right into this. Who all was in the class last, the mortgage roadmap 101? This is the 102 class. This is the follow-up. This is the more probably complicated of the two. Who all was in the first one? Great. Okay. Wonderful. Okay, it is 102, and to respect everyone's time, I think I'll jump right back into this. Welcome aboard. The design behind this class again is to help realtors understand the background or the mortgage business from a Cliff Notes standpoint. We're not trying to teach you everything. What we're trying to teach you is what's important to you to be able to properly manage your customers. There's a lot that goes on behind the scenes. Last week we discussed the trivia question. It was how many people are involved in a loan or a real estate transaction. It's not a trick question. It's just kind of an interesting one. There's anywhere from 15 to 19 people. Yes, I said that right, 15 to 19 people. There's your loan officer assistant, there's a processor, an underwriter, an escrow officer, a title officer, there's the appraiser, there's the appraisal management department, there's the homeowner's fire insurance agent. If it's a condo, there's a condo review department. You have the doc draw person, you have the notary. You have a funder, you have somebody wiring out the money, and you have recording at the county recorder's office. So organizing all of that is basically the job of the loan officer as well as the real estate agent to make sure we hit all those processes. We also talked last week about the process of closing a loan. If you've missed it and would like the flyers, I'm glad to email them to you. Just drop your email in the box. The process would be the application, which moves to a processor, which moves to an underwriter. The underwriter gives us the conditional approval. Next, we meet those conditions. The loan, you're not done once you get loan approval. That's just the beginning of the, that means we can all move forward with the loan approval. But it's called a conditional approval. The conditional approval, we go back out, we meet those conditions, whatever they are, send it back to the underwriter to get what's called clear to close. So as a realtor, you're going to want to ask your loan officer, what's holding up clear to close? That's a smart question. Keep that in the back of your mind. Clear to close is the magic, okay? Once it gets to clear to close, we still have to balance it out with the escrow officer and the funder. Before we order the loan docs are then ordered, shipped to the escrow officer. The escrow officer is now going to assign a notary. The notary is going to set up an appointment with the customer for signing. Once the docs are signed, they're going to come back to escrow. Escrow is going to get them back to the lender. Then the funder and the escrow officer talk one last time. The funder funds the loan. Money goes to the escrow officer. Escrow officer disperses everything. And in most counties later that day, you record. In some counties, you have to record the following day. So that's the in a nutshell, the loan process. And we talked about the needs list real quickly. There's a property needs list, which is for you guys, well, for most realtors, it's going to be the purchase contract, and it's going to be the addendums that are attached to the purchase contract, as well as all the disclosures and disclaimers. We're going to get from the customer the assets. That's the second big group of documents that need to be gotten. The assets, obviously, are the bank statements, and then the income statements. And income statements can be as easy as W-2s and 1099s, as well as if they're self-employed, all of this tax returns for 2 years for both the business, if they have business tax returns, and personal tax returns. We talked briefly about, and this is from a realtor standpoint, one of the questions you're going to want to ask your buyers is, how do you generate your income? Is it W-2 income, which is super simple and easy for all of us? But if it's self-employed income, things become complicated real quick, because what happens is on the tax returns, they don't claim as much as they generate because they don't want to pay taxes on everything they generate. So they have huge write-offs. That's where we all get in trouble. So an important question to ask them. There are 3 loan silos that we discussed. There's your tax return loans, which is Fannie, Freddie, FHA, VA, jumbo loans. That means if it's necessary, it requires their tax returns, but not mandatory. But if necessary, definitely required. And then there are a second silo was no tax returns. So this is for mainly the self-employed people, where we can do asset depletion. We can use the income stream or the rental income on the property to qualify them. We can use 12 or 24 months of bank statement deposits to qualify them. We can use a W-2 only without the, I'm sorry, well, we can actually use W-2 and pay stubs without a tax return, and that does come into place in certain circumstances, particularly if the customer has rental properties, because that triggers the need for tax returns. And then the other one was 1099s, which is what most realtors are. You're paid probably a 1099. And your tax returns probably deduct a lot of your expenses for your open houses, your signs, your flyers, your brochures, your driving around, all your meals and entertainment. So your income isn't as high as your gross, what you produced. So you pay taxes less on that. So there's a 1099 only program, which fits realtors really good without the need for tax returns. Okay, so that brings you up to speed. Any questions? If there are, throw them in the chat real quick. We can go over that at a later date. So let's get the presentation going. I am hoping this is being shared. Let's see here. Share screen. Share. All right, this is good. And now I'm going to go to the presentation, and I'm gonna give me one sec here. There's a button down here I can't see how to get to now. How do I minimize this? There we go. Bam. Okay. Let me go back to here. Does everybody see the screen? Let me find the chat box. Yes, see the screen? We good? Okay, great. All right. I'll do the best I can. I'm on one screen today. I'm working up in Los Angeles out of a hotel room. I'm on one small laptop. I can still do this. It's just gonna have to move in and out of screens. Just thank you in advance for your patience. Okay. Mortgage Basics 102. Jeffrey Scott. Here's my email address. You might want to jot it down. Jeffrey.scott@nafinc.com. NAF is an acronym. It stands for New American Funding. And now we're going to jump into loan structures. The first slide that I actually really want to talk about, well, the first thing that I want to talk about is this. One of the things as a realtor that you're going to want to ask your customers is there how much cash do you have to close on the transaction? That number is very important, and 0 is an okay number, all right? But we need to know what that number is. So when you're asking a customer how much cash do you have, there's 2 avenues. Number one, they could be selling a departing residence. And if they are selling a departing residence, you're going to want to take the purchase price minus about 6%, and that's 5% plus closing costs. 5% is your realtor's commissions, and then 1% for closing costs, and that's going to give you a net number. Then don't forget to subtract out the loan that's on the property. Most people have a loan on the property, so you've got to pay back the old loan. And then don't forget to ask, are there 2 loans on the property? Because it's not uncommon for property owners to have a first trust deed loan and then what's called a second trust deed loan, most commonly known as a home equity line of credit, which also has to be paid off upon sale. So you net out or subtract those 2 loans, and on rare occasion, there's a 3rd loan. So always ask, is there more that I should know about? Because it'll get sticky. Subtract all the loans, and that's going to give you a bottom line number of cash available for the new transaction. Now, here's the trick question to ask them. Of that amount of cash, how much are you willing to part with? Okay, so let's just use the example that the customer has $200,000 left over cash from the sale of their departing residence. And you point blank ask them, how much of that $200,000 are you willing to part with? They might only say, oh, I can only part with 100,000. And you're going to have to ask, well, why? And you're going to find out, well, I got 50,000 in student loans I want to pay off, and I got 50,000 in credit cards I want to pay off, or I got a car I want to pay off, or I got a kid going to college next year, or I've got medical expenses or whatever. So even though you and I want to race in and say, hey, I got 200 grand to go put down on a new $1 million house at 20% down payment, that sounds easy to me. The truth of the matter is the customer doesn't want to part with all 200. So it's real important to find out what they're going to part with. Okay. I'm going to try to find another slide real quick that is a little that I did not get. I wasn't able to get this thing loaded. Let me go to the chat box, see if there's anything in there. Nothing in chat. Great. I'll try to keep monitoring that. And let's go here. We're going to talk about this particular slide, and I'll just check real quick. Does everybody see this slide? Okay, check the chat. I've got a different slide up. I'm out of the PowerPoint. Yeah, can see that. Okay. Okay, great. I'll trust that we can see it. Loan structure. Great. Okay. So here's where we're going with the conversation. Once you know what your cash to close is and what the customer is willing to part with, then we can start to structure the loan. Now, this is information that you don't necessarily need to know, but I think it's good information for you to know, in that what we look at is the purchase price equals 100% of the transaction. If the customer is willing to put in 20% down payment, then that is called a traditional or a standard 20% down payment. Now, we do all types of down payments, but what comes with the 20% down payment is that there is no mortgage insurance required on that particular loan. So you're not paying the bank an additional fee if you come in with a full 20%. But I don't want you to think that mortgage insurance is a bad thing. In fact, mortgage insurance is your friend. I love mortgage insurance, and I've used it on numerous occasions personally, and I will explain why. But it's in a nutshell, it's the cheapest cost of money that one can get when in need of mortgage insurance, when you don't have the full 20% saved, or you don't have a rich uncle that's going to give you that money. Okay. So we'll go into mortgage insurance at a later time, but that, trust me, you don't, it's not a bad thing. So once we identify how much money they have for a down payment, and 0 is an acceptable answer. I know it's hard to believe. Customers say, I have 0 down payment. Well, that's an important number to know, because there are loans that are available today where we can get a customer in with 0 down payment, which brings up a side point. If you have a pen and paper, write this down real quick. Down payment equals your equity investment in the home. Down payment is your investment in that asset that is coming from your cash reserves to the seller, basically, and it's buying your, it's your investment or your equity in the home. Closing costs are an additional cash required to close on a real estate transaction in the state of California. For example, you have, by law, you have to hire a third-party vendor, which is your escrow officer. You have to buy title insurance to make sure that the pink slip on the house has no anything that would materially affect the value of the house. And if something is found, like a surprise lien, that insurance pays for it. You have your transaction, you've got your recording fees, your tax transfer fees, your appraisal, your underwriting fees, your processing fees. The fees goes on and on and on. So you got to budget about $5,000 for all of those fees. And then you have what's called prepaids. This is not a well understood number, but we really go through it with our customers so they understand what their prepaids are. But one of the biggest prepaids is interest on the new loan, to set the loan from starting at the first of each month, which is your first payment, always starting at the first of each month. And what you do is if you close the loan on the 15th of the month, for example, you prepay interest to the 30th of the month, then you skip a month, and then your first payment's the trailing month after that. But you have to come up with cash, which compound when you're already coming in with your down payment and you're already coming in with your closing costs, and now you got prepaids, then it starts to add up. So now your 5,000 extra that you needed now jumps to 10,000. And then the other prepaid item is funding an impound account or an escrow account for prepaid real estate taxes and prepaid fire insurance policies. And you had to pay your 12 months fire insurance policy up front to get the loan. So you not only need to fund your 12-month fire insurance policy, which can run you $1,500 a year, but you need to now fund, depending on the cycle in the year that you close in, your impound or your escrow account for fire insurance. So when the bill's due, there will be enough money in the account to pay that bill or that invoice. So now all of a sudden you're looking at $15,000 to $17,000, or even $20,000 to $24,000 in additional cash to close. So if the customer said, I am willing to part with $100,000 for my down payment in the new house, your next thought is okay, well, really, are you telling me, do you want to pay $75,000 for the down payment and use $25,000 for all of your other cash to close items? Or are you saying, I'm willing to invest $100,000 in the house and I got an extra $25,000 to cover my total cash to close? Does that make sense? So there's a $50,000 swing there between $75,000 and $125,000 that you got to get sorted out. Let me shoot in the chat box. Yes, it's low structure, so we're looking good. No questions. Okay, great. So now, once we identify how much cash they are willing to part with for the investment in the house, their down payment, and 0 is okay because there is a loan out there where you do not need a down payment, you still need all of these non-recurring closing costs and prepaids. You can get into a house with 3.5% down, which is well, 0 is your rock bottom, and that only rolled out in January. So that's the newest of the new program. By the way, it's called Pathway 100 if you want to write that down. It's an FHA loan, but Pathway 100 means it's 100% financing. So that's what the 100 stands for. Up until January, all we were offering is this loan right here, which is the 3.5% down FHA loan. And that also is one of the most aggressive loans in the marketplace. That's the easiest to qualify for. So it takes credit scores down to 500. It takes debt to income ratios up to 56.9, right under 57%, which is huge. It'll take 2 years out of bankruptcies. It'll take student loans and only rather than playing a full one. Well, if the student loan is not showing up on the credit report, we'll backfill it with like 0.5% of the balance that's outstanding. It's a lenient loan. It's the most lenient loan. If we put 3% down, then it's not going to go FHA. What it's going to do is going to go a conventional loan with a 90% or a 97% first trust deed loan with PMI, which is private mortgage insurance, also called MI, which is mortgage insurance. You use those synonymously. You can come in with 5% down in a 95% loan. You can come in with 10% down with 90% loan. You kind of see how that's structured. Everything's based off 100%. So we have to get to 100% somehow, and we're going to get there with the customer's down payment and then with the loan itself. And then another structure that we don't see as often, but it's very common, is a 10% down payment from the customer or the buyer, an 80% first trust deed loan, and then a 10% home equity line of credit. So you still equal 100%, but you're doing it with now 2 loans and the customer's down payment. Okay. Where loan structure gets kind of interesting is in these conforming loans. And I'll back up real quick and try to explain it to you without over explaining it or over complicating it. The United States government has sponsored entities. They're called Fannie Mae and Freddie Mac. VA and FHA and USDA if you want to go down that road, but that's rural properties. Your big ones are Fannie and Freddie and VA and FHA. They are government-sponsored programs. They're they're not owned by the government. They're privately owned, but they are overseen by the government for the good of all Americans, from Los Angeles to New York City, and everybody in between needs to be treated fairly and equally. Okay. So what they do is they come up with this conforming loan limit, and it changes every year. It's up to now $766,550. So you can get a conforming loan that fits Fannie, Freddie, FHA, VA, up to that loan amount anywhere in the United States. Now, in certain high rent districts, we have what's called a high balance conforming loan. So they look at cities like San Francisco, Los Angeles, San Diego, Denver, Dallas, New York City, Chicago, Miami, and they say, all right, your average median home price actually is a lot higher than Nebraska and South Dakota and Wyoming, and we're trying to treat everybody fairly. So since yours are higher, we're going to give you a higher loan limit for your county, but we're going to charge you more for it to keep it fair for the guy that's living in Wyoming. That's the theory behind it. And it's not a bad theory, really. It does cost a little bit more for a high balance loan, but we use them all the time. And what's interesting about the high balance loans is that they go up to 1,149,000, which is almost 1,150,000. In the highest of the high rent districts. Okay. And then a jumbo loan is going to be, depending on the county, and this is kind of gets confusing also, depending on the county, is 766. It's a dollar over this conforming loan limit of $766,550. So a dollar over that, in most cases, will be a jumbo loan. In the event, if it's a high balance, sometimes depending on the jumbo lender, it could be even higher at the end of the day. So those are your three loan buckets that now we have to figure out what your customer fits in, okay, and why they fit there. And we were speaking briefly over here is the high value counties. This is where it even gets more confusing, is because I do a lot of business in California and I'm constantly looking up these counties because there's a bunch of them. San Diego County will go to $1 million. Orange County goes to the $1,149,000. But Riverside County is capped at 766. So you can't get $1 million loan, conforming loan out in Riverside. You now are in a jumbo loan out there. San Bernardino, it changes to 760. Oh, San Bernardino's the same, my bad. San Francisco is a high rent. It maxes out. Napa Valley doesn't max out. Napa County, sorry. Sacramento County, 766, 550. Ventura County is 954. So see how they all the counties are different. So now we got to figure out what county we're playing in. That's one of the first questions we need to know. And then the FHA limits are even different. So depending on the county, Riverside only gets a $644,000 loan out there. Now that really surprises me personally. I would think they would have at least honored this 766,000, but they haven't. FHA just takes a different view on different counties. They think that for whatever reason there's a lower median home price out there, and so they've just adjusted for it. So that's this can be real problematic when the customer thinks he can get a $766,000 loan out there. But it turns out he needs an FHA loan, and now all of a sudden they're capping him at 644. So it's problematic. I'm going to shoot in here, see if there's anything in chat. Okay, great. Nothing yet. Anything pops up, let me know. All right. So that is basically how we get to loan structure. And as you can see, there's so many different moving parts, but it all starts with cash to close. So that's why it's important for you to know that number at the end of the day. Okay, going back to loan structures versus down payment. This slide basically shows what I just explained on the other slide. And we're going to move on to pricing, if everybody's good with that. Pricing good? Just check the screen. Whoops, no open questions. Okay, great. All right. So now loan pricing is pretty interesting. One of the things that we get a lot of customers that call us up and say, what's your rate? And that's a really hard thing to respond to. And a lot of times, if they're a rate shopper, then they don't want to go into the nuances of how you calculate a rate. But I think it's important for a realtor to understand, please don't ask your loan officer what's your rate, because that's a terrible question to ask. The question to ask is this: I have an owner-occupied single family residence that wants a 30-year conforming loan. Then we can offer you a rate. Or it's a condominium with only 10% down, not the required 25% down on condos for a pricing adjustment. And and credit score is real important. So this slide gets complicated, so I don't want to really use it. So I'm going to try to pull up the I'm going to go back to this pricing. What's my rate? So these variables all dictate rate. So without me knowing these variables, I can't give you a rate. But if you're gonna throw me up against the wall and back me into a corner and tell me what's your rate, I can say 6%. But it does nobody any good because I don't know their FICO score. So look at these tiers right here, 660 to basically 80, 680 to 700, 700 to 720, 740 to 760, 760 plus. Each one of those has a different pricing component. And the theory is it's called risk-based pricing. So if your customer calls me up and says, what's your rate? I need to know your credit score. And they say, my credit score is great, but that doesn't tell me what their credit score is. So I have to adjust for that and guess, well, are you a 700? Or do you feel like a 720 today? Or should I just max you out at a 760 and give you the rock bottom price and see what your score comes in when it comes in and change it then? So that game's played all the time. The other thing is the property use. You have 3 classifications for property use. You have owner occupied, second home or a vacation home, and an investment property. Let me see, did something pop in here, chat? Okay, the mid FICO is taken into consideration or the lowest. Okay, good question. So there's 3 credit scores that are applied to all customers, including you and me. I'm ranked on by Experian, TransUnion, and Equifax. If it's just me on the loan, there's 3 scores. They're going to take the middle score. So the theory is they throw out the high, they throw out the low, and they take you on the middle score. If my wife or my spouse or my partner's on the loan, they're going to look at her 3 scores. They're going to pick her middle one, and then the lowest of those 2 will be what the loan is written off of. So in my case, true story, I had like a 740 credit score because I'm a banker and I do everything right. My wife's a chef and she's got some student loans and her score came in at under 700. Well, it hurt us when we bought our condo because the pricing was based on her credit score. Now, did I care? No, because I need a home, and we fixed her credit, and when we refinance, we're going to get the higher back anyway. So that's how that has worked. So it's the lowest middle score of all the borrowers that's on the loan. Okay. The other thing we need to know is what kind of use is it? Is it owner occupied, a second home, and an investment property? And here's the theory: if we're going on a risk-based price. Risk-based, okay, the highest risk, the highest return to the investor that's lending you the money. If it's owner occupied, here's the theory: if you get into financial trouble, an investment property with the house that you have down, out in Hemet that has 3 tenants in there, if you get in financial trouble, you're going to probably let that house go first because you don't care about it. And it doesn't affect your life on a day-to-day basis. Yeah, you lose your investment and things are tough and whatever, you lost the house, but you're going to let that house go into default faster than the other 2 properties. Then your second home, let's say you've got a Big Bear cabin and you like to fish and that's your jam and you want to protect your Big Bear home and your cabin and your weekends to the best of your ability. But if you're in a financial jam, that's a luxury. So you're going to let that house go before your owner-occupied house. Your owner-occupied house is the roof over your head. It's where your family sleeps. It's where where all your junk is. It's where you live. So you're going to fight tooth and nail to save that house over the other ones. So that's why the pricing's higher on the other on anything that's not home. If it's an owner-occupied house, your pricing is A. Anything that's not owner-occupied, the pricing just goes up. How much down payment is a good question. So if the customer says, I got 0 down payment versus the customer who puts 20% down, there's a investment risk differential because if the person puts nothing down, the lender's lending 100% of the purchase price. So the buyer has no risk. So there's no skin in the game. So the guy who puts 20% down is going to get the better rate because he's got skin in the game or she's got skin in the game. So that's your down payment, which is the same as the loan to value. And then we have to look at the conforming loan amounts. What's the loan size? That's a very important question, because if it fits conforming, great. But if it doesn't fit conforming, then you're now looking at a high balance number, which automatically comes, it's at least 1/4 to 3/8 higher in interest rate. And if it's a jumbo, it could even be higher. And then we have to look at the property type. So a single family residence is the normal or the baseline. And then when you change from there, the pricing goes up. So on a condominium, because of the 2008 mortgage market meltdown that drug the entire economy all the way down to 2015, that 7 or 8 year window, condominiums got obliterated. And Fannie and Freddie are still recouping their losses on condominiums. So if you don't put at least 25% down on a condominium, you get surcharged. So that's $1 million question. I don't know if you're buying a condo or a house. If you say, what's my price? I don't know if it's a condo. I don't know if it's a single family, and I don't know what your down payment is. So that gets tricky. Then if it's a 2 to 4 units, you get a pricing hit. And if it's a manufactured home, you get a different pricing hit. Going up here, I already explained the condos. Your debt to income ratios come into play. Mortgage insurance comes into play. Anytime you don't put 20% down, then your interest rate goes up and you have mortgage insurance. Now, it's not significant, but if you're asking me what my price is, and I don't know how much your down payment is, these numbers affect it at the end of the day. Loan programs can affect it. Underwriting styles can affect it. If you call me up and say, hey, what's your price? And I say 6%, then all of a sudden you turn out to be a self-employed bank statement loan and you want $2 million on a fourplex. My 6% is not 6%. Does that make sense? So pricing is real finicky and real tricky, and you're really, to do pricing right, we do it all on the computers now, and we put in the customer scenario, and then it kicks out different prices for us to offer the customer. And that's the proper way to do it, but a lot of people are just, what's your price? So, okay. So we covered cash to close, we covered loan structure, we covered loan pricing. Any questions on that? Kind of a deep dive on that. And we're going to go into let's go back here to these are the pricing charts. You can actually Google this. You can type in Fannie Mae, Freddie Mac, loan level pricing adjusters. It's called LLPs. An LLP is basically, well, it's a loan level pricing adjuster. It's risk-based pricing. In this case, I highlighted if you've got a credit score of over 740 and you're putting in 40% down, there's no pricing adjustments. But what happens if I have an under 700 credit score and I'm only putting down 20%, you know, to 80% loan to value? There's a 1.75 points that needs to be paid to Fannie Mae and Freddie Mac. Now, that's not an interest rate. That's additional points for that borrower. And let's say that they only want to put in 10% down and their credit score is under a 660. That's 2.75% points that need to be paid to Fannie and Freddie, not me. That needs to be accounted for generally in the pricing. So it's just a higher price. So that's what it looks like in real life. This one is the investment property. If you're buying an investment property and you're coming in with 25% down, you still are hit 2.125% points on that interest rate or on that transaction. And these are being stacked, okay? That's plus. If it's a 2-unit or a 3-unit, there's a 1-point add. We mentioned a condominium under 25% down payment. If you can't come in with at least 25% down payment, you get hit 75 basis points. Okay, just it adds to the pricing stacked on. The high balance loan is 0.25 to get a loan over the high balance limit. So I said a quarter over to 3/8 over. For some reason, I've seen it priced as 3/8 over, but this is just saying a quarter, and this might be a little dated, but you get the idea. If the loan's a cash out loan, that even triggers something different. You know, if the customer says, "What's your rate?" but he doesn't tell me it's a condominium and I want cash out and I got a 660 credit score, it's real hard to give them a rate. But look at this cash out rate now. You know, the average American is about a 680 credit score. So most people are looking at this 1.75 in points that's going to affect their rate. Okay. So that's kind of the deep dive on the pricing and the LLPAs. Wanted to just touch on underwriting. Underwriting is when we send a loan to underwriting, they're highly paid individuals. They, you know, they're 100 to 140 a year. If they're an underwriting specialist in Fannie Mae and Freddie Mac, there's about 1,200 pages of guidelines that they have to follow. Think of the guidelines as the rules. Think of it this way, is that if the customer fits all of those rules, he gets a loan from LA to New York, and everybody in between treated equally. Okay, so that's your rule book. And you can Google Fannie Mae's guidelines and you can look up guidelines all day long. And these change all the time. So it's gotten easier to follow guidelines, especially with the advent of the computers and using automated systems to filter all those guidelines for us to come out with what's called an approval, or an AUS approval, which is an automated underwriting system approval. Freddie Mac has about Freddie Mac actually puts their guidelines and their servicing together in one big book. That's why they have 2,000 pages. I should probably look up what the servicing is for Fannie Mae just to see if they're equal, but they're very close to being the same amount, 1,300 pages of rules that you have to follow. Jumbo lenders are a little different. They don't have as many rules. They play by their own rule book. And so their guidelines are around 200 pages, dependent on the jumbo lender himself. And when I say jumbo lenders, what I mean is that's a loan that doesn't fit Fannie Mae or Freddie Mac's guidelines. So anything that doesn't fit their guidelines is going to default outside of the box into jumbo lending or these tax return loans. What we call them Wall Street loans. So there's a whole different bucket out there available to customers that we can utilize. Non-Q, they're called non-QM, which means non-qualified. Not to get too technical, but these guidelines could be as low as 75 pages. And then the community loan, which is the United States Treasury loan that doesn't require any income documents whatsoever. It's kind of the bailout to the bailout loan. I looked their guidelines up as 24 pages. But remember, that's the loan that all you need is a good credit score and cash in the bank, and you can get a decent loan. And it's not a hard money loan. So that's kind of what underwriting is the guidelines or the rules. And if you follow all the rules, you get the loan. And if you break a rule, you don't get the loan. Or if you follow all the rules, but you are outside of the box, and we can fix it, which we do, and you fall back inside the guidelines, we can give you a loan, and 30 days later, you might fall back out of the guidelines. But during that time frame, you fit the guidelines, okay? And if you fit the guidelines, you get the loan. So that's the cool thing about that. All right. The next thing I just wanted to touch base with you, that's pretty much wraps up that, but I did want to talk to you about these are the underwriting methods that we just went through. I'm not going to get too involved again in them, but you've got tax return loans, you have no tax return loans, and then you have literally the community loan with no income documents whatsoever. But I want to get into this. This is kind of important to know. It's a little bit of a deep dive. Let me just check the time, 1:46. So we got 10, 15 minutes left. Interest rates. Think of the lender, and the lender wants a return on his money, and the return on that money is based on the risk that he's going to take. Okay. And so if a single family residence, owner occupied, 20% down payment, 760 credit score, like a cherry deal, right? If let's just say that interest rate is 7%. Okay. If we're using 7%, there are times when the customer says, I really want 6%. And I'm like, I know you do. And I want you to have 6%. If you want to, and this is called an interest rate buy down, if you want to buy your 7% interest rate down to 6%, you can chip in an extra fee to the investor, and he will give you that 6% interest rate. Now, there's reasons to do that, and there are reasons not to do it. One of the reasons to do it is because if you can't qualify for the loan you want at 7%, but you can qualify for the loan that you want at 6%, it may force you to pay points to buy the lower interest rate down. And the investor or the bank doesn't care because he's collecting his points, and now he's willing to accept that 6% return. That's called a permanent interest rate write-down. It lasts for the full 30 years, okay, of the loan. Now, none of these loans have a shelf life of 30 years, but conventional thinking is that this is my last loan ever, and I'm never going to change this loan, and therefore I want that 6%, or I need that 6%, so I'm willing to pay for that 6%. But here's what happens. Life events occur over that 30-year window that they didn't plan for. Things like you've got 2 children, and now you're pregnant again, but this time it's with triplets. So now you've outgrown your house space and you have to move. In my case, it was a divorce. So divorce, sell the house, move. It could be medical problems that you need to now refinance the loan to take cash out to pay for huge medical bills or college bills, or you just decide you want a swimming pool in the backyard. There's those types of changes. There's job losses. There's job opportunities to move to a different state for a better job. There's all these life events. So people think 30-year fixed. 30-year fixed just makes the amortization schedule or the payments easier to stomach over a 30-year window because there's 360 payments. But these loans never last that long. So if in the event that rates were, I'm just trying to think of a decent example to pay points. Let's say, I can't really think of a good example to pay points. You have to really be in fear that rates are going to go to 10% forever. And you want the lowest interest rate for the next 30 years and you're never going to move, then it makes sense to pay points. I can make so many arguments not to do it, but it's done all the time. And it also is definitely done to qualify for the house. So there's that. Then there's what's called a temporary buy down, and this is kind of interesting. This is where the customer says, okay, my rate I'm going in at today is 7%, but I just gave you $200,000 of my cash for the down payment and another $24,000 for non-recurring closing costs. I'm low on cash. I need to rebuild my reserves. I know that I got to put a hot water heater in and a kitchen sink, and I got to remodel this and that bathroom and blah, blah, blah. So I know I've got to be coming out of pocket with more cash. What can you do to lower my interest rate temporarily? And there are called temporary buy downs. So you can actually buy down the interest rate for a period of 1 year, or a period of 2 years, or a period of 3 years. Okay. And it's a fee that you pay up front. And what's cool about it is that the seller can actually pay the fee also. So in a lot of cases, we see seller concessions today, and the seller will give a seller credit of $10,000, and the customer might look at that $10,000 and say, wow, if I'm getting that $10,000, I can use it for my closing costs, or I can use it to buy my interest rate down. So a 2-1 temporary buy down, I think somebody is chatting. What happens after the expiration of the temporary period? It goes right back to the note rate, which is the original rate that it started at. So in this particular case, if you can see this, we're going to start with the customer is going to accept a 7% rate today. We're going to do a 2-1 buy down. And what that means is in year 1, he's going to get a 5% rate, and he's going to pay 12 months of payments using a 5% interest rate. In year 2, he's going to use he's going to make 12 payments of 6% interest rate, and then in year 3, it's going to kick back up. So temporary means it's for a short period of time. It gives the customer some breathing room in the first 1 or 2 or 3 years, and then it reverts right back to the old note rate, which was the original rate that you went into the transaction with. In this particular case, a 1-1-1 buy down that lasts for actually 3 years, which is pretty interesting. If you started with a 6% rate today, then you would have a 5% rate for the first 3 years. And then in year 4, it goes back to 6%. In this particular buy down example, if the rate, this is a 1-0, it's a pretty simple one and a pretty common one, actually. If the rate's 6% today, we're going to buy your rate down to 5% for the first year. And then in the second year, it goes back to 6. So that gives you 12 months of breathing room to replenish your reserves, to just take the enjoyment of the lower payment, and just get accustomed to the loan and making those payments in your new lifestyle with your new mortgage payment, which comes with property taxes, which comes with fire insurance policies, and could come with an HOA fee of some sort, of homeowners association. So you do ratchet up in payments, although some of that's tax deductible. And so after you tax deduct it all, then that cash out of pocket drops back down to it's a more manageable number at the end of the day. But this is another way to help manage that. Okay. Any questions on that? About 6 minutes left. Okay, so I did want to talk to you about mortgage insurance and why mortgage insurance is your friend. And I don't want anyone going around and saying mortgage insurance is bad, mortgage insurance is evil, you don't want mortgage insurance is expensive, mortgage insurance, you got to save your 20%. Whatever that nonsense is, throw that out the window, because it is dead wrong. Mortgage insurance is the greatest thing that has been made by man since butter. Okay, and butter is really good, I think. Mortgage insurance, what it does, why it's so helpful, is because it allows you to buy a house today when you have not been able to save a 20% down payment. Okay. So now, if you get gifted from your dead granddad or whatever, an inheritance gift, and you have 20% down, then yeah, you don't need mortgage insurance. But if you were brought up like me, not really, well, I have no inheritance and don't plan on having an inheritance. I know how my parents live, and it's frugal and it's below the radar. So I don't have anyone gifting me any money. So I had to get in to the housing market, and you can only save so much money per year, or you can only save so much money per month. So let's just use this fun example. If I wanted to buy a $500,000 house with 20% down, I need to save $100,000 in cash. Now, just think about that. How hard is it to save $100,000 in cash? That's an astronomical number to save. So if I can save $500 a month, it's going to take me 16 years to save $100,000. Let's even ratchet it up and say I can save $2,500 a month. Me and my wife, we're gonna live in a RV, and we can squirrel away $2,500 a month. It's gonna still take me over 3 years to save that. And here's what happens during these time frames. Appreciation keeps making the house go up. So the house appreciates 4, 5, 6, 7, 8, 9, 10% each year while I'm trying to save for this down payment. So what we say is it's your friend. You lock in the purchase price today as quick as possible. And even though you have a mortgage insurance premium payment, it far underweighs that small expense of even $200 a month in this example doesn't hurt your overall profit from the home's appreciation over time. Okay. So mortgage insurance is really your friend. Even if you only can get in with 3% down or 3.5% down, we strongly advise you to take advantage of it today. Pay your mortgage insurance, wait till the home appreciates. And once the home appreciates to a certain degree, you can wipe out mortgage insurance. It's not permanent. None of these loans are permanent. Okay. So mortgage insurance really is your friend. I love it. I encourage everybody that doesn't own a home to please use this to get a home, because wealth is generated in home ownership. It's the most easy way to generate wealth, and even generational wealth is through home ownership. And it's the only thing. See, when you and I generate income, we pay one of two people. You always pay the man, but which man are you going to pay? Are you going to pay the IRS in fat taxes, or are you going to pay the bank fat interest rates, but have the chance for appreciation by owning a $500,000 asset? I'd rather pay the bank and get my house to appreciate over 10 and 15 and 20 years. So if you are renting, your rent is not only 100% interest, but all of your money is being paid to the IRS. You have no tax breaks. And so owning, now you get not only the tax breaks, the government helps you with your mortgage payment, which is a real head scratcher, but that's the way it works. And they don't help you with your rent payment very much. I think the state of California gives you a little credit, but it's pennies. The government would actually help you on the mortgage, and you have now a $500,000 asset that's going to appreciate over time. So, Okay, did you mention the slides will be emailed to us? We have a deck page that's going to be emailed to you, but not the actual slides, okay? The deck page does a better job of it. I'm in the deck page right here. And so you're going to get a copy of this. Mortgage Insurance is Your Friend. You're going to get a copy of this, the interest rate buy downs. There's two of them. There's the permanent one and the temporary one. Permanent one's forever. The temporary one will only go out to about 3 years. This is your underwriting methods. Again, the first question you want to ask your customers, what do you do for a living? Because that will summarize quickly, are they a W-2 employee? Sorry, are they a W-2 employee, which is generally your easier ones to underwrite, or are they self-employed? And if they're self-employed, there's nothing wrong with it, because there's a lot of self-employed people that make, $1 million a year. So we get them qualified. It's not a problem, but it does require 2 years of tax returns for the business, 2 years of tax returns for the personal, requires profit and loss statements, and it goes down a different rabbit hole. You'll get this slide on pricing. Just please remember this. When you ask your loan officer, what's my price? Or what do you got? What's your price? Don't ask them that. The smart, intelligent question is, Jeff, I have a single family residence. His credit score is 760. He's putting 20% down. It's a conforming loan over 30 years. And that's pretty much it. What's your rate? Then we can get you a solid rate. Okay. That's what it requires. You'll get this sheet, and then you'll get this sheet also on loan structure. And always remember, loan structure, basically you start with 100%. Then you ask the customer, how much cash do you have available for the new transaction? And they're going to always inflate it. And they're going to tell you, I got 100 grand. And you're going to say, but how much of that money are you willing to part with? And they're going to say, well, I only want to part with 25 grand. And you're going to say, okay, so you're going to part with 25 grand for the down payment, but you still need your non-recurring closing costs, and you need to fund your impound account, and you've got your prepaid interest on the new loans and other prepaids. So you need about another 15 to 25,000, depending on the loan size and the purchase price. Where's that money coming from? Oh yeah, okay. Well, if I have to go to 100, I'll go to 100, but I'm not going more than 100. That's how you back into structuring your loan. That's the magic. Okay, questions here. Slides. Thank you. Got to run. I completely understand. Thank you, guys. Email me with questions. We'll email the slideshow out. Thank you for having me. Any questions, anytime, contact me, okay? Thank you all.